January 20th, 2026, Tokyo. The yield on Japan's 40-year government bond just hit 4.24%. For the first time in 3 decades, a Japanese sovereign bond breached 4%. And in that single moment, the entire architecture of global finance shifted beneath your feet. But here's what the headlines won't tell you. This isn't just about Japan. This isn't just about bonds. This is about trillions of dollars in capital that for 30 years flowed west, kept U.S. Treasury yields suppressed, funded American deficits, and anchored global interest rates at artificially low levels. And that flow just reversed. While every analyst is watching stocks, currencies, and central bank meetings, a silent exodus is underway. Japanese institutional money, the largest pool of foreign capital in existence, is coming home. And when it does, it's not flowing into U.S. treasuries. It's not flowing into European bonds. It's bypassing the entire Western financial system and flooding into the one asset the establishment does not control: silver. Not gradually, not over years, right now. And the mechanism driving this isn't speculation. It's mathematics. It's survival. It's the largest forced reallocation of capital in modern financial history. And if you don't understand what's happening in the next 35 minutes, you'll wake up 6 months from now wondering why silver exploded while everything else you own lost value. This is the story of the Bank of Japan kill switch. The bond market rebellion that's routing trillions away from America and directly into physical metal. And why the window to position yourself is measured in weeks, not months. Let me show you exactly what broke and why it can't be fixed. To understand why January 20th, 2026 will be remembered as the day global finance fractured, you need to understand what Japan has been to the world for the last 40 years. Japan isn't just another economy. Japan is the world's largest creditor nation. As of the end of 2024, Japan held 533 trillion yen, approximately $3.7 trillion, in net external assets. That's more than any other country on Earth. For decades, that capital flowed outward. Japanese pension funds bought U.S. treasuries. Japanese life insurance companies bought European bonds. Japanese banks financed global trade. This wasn't charity. This was a necessity. Because in Japan, interest rates were zero, sometimes negative. A Japanese pension fund managing retirement savings couldn't earn anything domestically, so they sent money abroad. They bought 10-year U.S. treasuries yielding 3%. They bought European corporate bonds yielding 4%. They hedged the currency risk and locked in positive returns. This created a system. Japanese capital flowing west suppressed Western interest rates. It allowed the U.S. government to borrow $2 trillion per year at affordable rates. It allowed European governments to fund deficits without triggering bond market revolts. The entire Western financial system was built on an assumption. Japanese money would always be there, always buying, always suppressing yields, always providing the liquidity that kept the machine running. That assumption just shattered. On January 20th, 2026, Japan's 10-year government bond yield hit 2.33%, the highest level since 1999. The 30-year yield surged to 3.92%. And the 40-year yield, the one that matters most for pension funds with long-term liabilities, exploded to 4.24%. Do you understand what that means? For the first time in 30 years, Japanese institutional investors can earn 4% at home, in yen, with no currency risk, no hedging costs, no geopolitical risk, just straight 4% annual returns on sovereign bonds issued by their own government. Compare that to U.S. treasuries. The 10-year treasury yields around 4.26% as of January 22nd. Sounds higher, right? But once you factor in currency hedging costs, which have been running between 200 and 300 basis points depending on tenor, the effective yield for a Japanese investor drops to around 1.5 to 2%. Japanese bonds at 4%, U.S. bonds at 1.5 to 2% after hedging. The math isn't close, it's not even in the same universe. And Japanese institutional investors, the pension funds managing trillions, the life insurance companies with decades of liabilities, they're not idiots. They can do basic arithmetic. And the arithmetic says, bring the money home. Here's where it gets worse. This isn't a choice. This is a forced liquidation. Japanese life insurance companies, giants like Dai-ichi Life and Nippon Life, hold massive portfolios of Japanese government bonds purchased years ago when yields were near zero. As yields spike from 0.5% to 4%, bond prices collapse. Because bond prices and yields move inversely. These institutions are now sitting on estimated unrealized losses of $60 billion, 9 trillion yen, on their domestic bond holdings alone. That's not a rounding error. That's a capital adequacy crisis. When losses of this magnitude appear, regulators start asking questions. Risk managers start demanding action. And the action is always the same. Liquidate foreign holdings to cover domestic losses. Sell U.S. treasuries, sell European bonds, bring the cash home, buy high-yielding Japanese government bonds at current prices to stabilize the balance sheet. This is not speculation. This is standard operating procedure during a bond market crisis, and it's already happening. On January 22nd, U.S. Treasury yields spiked. The 10-year jumped above 430%. Why? Not because of U.S. economic data, not because of Federal Reserve policy, because Japanese investors were selling, trimming their overseas portfolios, pulling capital back to Tokyo. The flow has reversed. The 30-year carry trade, the foundational structure of global finance, where investors borrowed yen at 0% to buy higher yielding assets elsewhere, is unwinding. Not gradually, violently. And here's the part that should terrify anyone holding dollars or dollar-denominated assets. The Japanese repatriation isn't a temporary phenomenon. It's structural. It's permanent, because Japanese yields aren't going back to zero. The Bank of Japan, after 30 years of ultra-loose monetary policy, has entered a tightening cycle. In December 2025, they raised the policy rate to 0.75%, the highest level in 3 decades. Governor Kazuo Ueda has made it clear. In October 2025, Takaichi took office with a radical agenda, aggressive fiscal expansion, a 21.3 trillion yen stimulus package, roughly $135 billion, and a proposal to suspend the 8% consumption tax on food for 2 years. Unfunded, no plan to replace the lost revenue, no offsetting cuts, just pure deficit spending. And the bond market revolted, because Japan's debt-to-GDP ratio is already 260%, the worst in the developed world, more than double the United States. Adding trillions in unfunded spending on top of that mountain of debt was the final straw. Bond vigilantes, the investors who refuse to buy government debt when the risk is too high and the yield too low, came back from the dead. They sold, aggressively, and yields exploded. The 20-year bond auction on January 20th was a disaster. Weak demand. One-way selling. Hedge funds caught on the wrong side were forced to liquidate. It was chaos, and it's not stopping. Because on February 8th, 2026, Japan holds a snap election. Takaichi called the election to get a mandate for her spending plans. If she wins big, fiscal discipline is dead. More spending, more debt issuance, higher yields. If she loses or faces a coalition, political gridlock, uncertainty, still higher yields. Either way, the bond market loses confidence. Yields stay elevated, and the capital repatriation accelerates. Now, let me connect this to silver, because this is where the story gets interesting, and where most analysts completely miss the plot. When the Japanese capital comes home, it doesn't just sit in yen cash. It needs to be deployed, reinvested. And Japanese institutional investors, the pension funds and insurance companies, operate under strict mandates. They need yield, they need safety, and they need diversification. In a normal environment, they'd rotate into Japanese government bonds, buy the 4% yielding 40-year bonds. Lock in the yield, sleep at night. But this isn't a normal environment, because Japanese government bonds yielding 4% doesn't mean they're safe. It means the opposite. It means the bond market just repriced the risk. When yields spike from 0.5% to 4% in a matter of months, that's not stability. That's a warning. The market is telling you that Japan's fiscal situation is unsustainable, that debt to GDP at 260% cannot be serviced without either austerity, which is politically impossible, or monetization, which means inflation. And inflation is the enemy of bonds. If you buy a 40-year Japanese government bond yielding 4% and inflation runs at 3%, your real return is 1% for 40 years. That's not attractive. That's a wealth destruction machine. So where does the smart money go? Not into yen cash. Inflation eats it. Not into Japanese stocks. The Nikkei is volatile, tied to global growth, and doesn't provide safety. Not into foreign bonds. The hedging costs make them unattractive, and the capital repatriation dynamic means you're swimming against the tide. The smart money goes into hard assets. Assets that cannot be printed, cannot be inflated away, cannot be defaulted on. And the two obvious choices are gold and silver. Gold, the traditional safe haven, has already moved. As of January 26th, 2026, gold is trading near $5,100 per ounce. It hit new all-time highs earlier in the month. It's up substantially from where it started in 2025. The world has already figured out that gold is the answer to currency debasement and fiscal insanity. But here's the problem with gold. It's expensive. At $5,100 per ounce, gold is out of reach for many retail investors. Pension funds can buy it, central banks are buying it, but the average saver? Not so much. And that's where silver enters the equation. Silver, as of January 26th, is trading above $107 per ounce. It recently broke through the $100 barrier for the first time in history. It's up more than 150% over the past year. It's outperforming gold, outperforming stocks, outperforming nearly every asset class in existence. Why? Because silver has a unique characteristic. It's both a monetary metal and an industrial metal. It's poor man's gold, affordable. accessible. But it's also indispensable for solar panels, electric vehicles, electronics, and advanced manufacturing. It has dual demand: safe haven demand, like gold, and industrial demand, which gold doesn't have, and the industrial demand is exploding. Solar panel installations are projected to quadruple by 2030, according to the International Energy Agency. Every panel requires silver paste for conductivity. Electric vehicle production is surging. Every EV uses roughly 3 times more silver than a traditional car. Data centers for artificial intelligence, semiconductors, 5G infrastructure, all of them consume silver. And here's the kicker. The silver market is in a structural deficit, 5th consecutive year. Demand exceeded mine supply by roughly 200 million ounces in 2025. There isn't enough mined silver to meet global demand. The gap is being filled by above-ground inventories, vaults, stockpiles, and those are draining fast. London silver inventories are at multi-year lows. COMEX registered silver, the amount available for delivery against futures contracts, has plummeted. Dealer inventories are tight. Premiums for physical metal are spiking. This is a supply crisis meeting a demand explosion. And now, add Japanese institutional capital to the mix. If even a small fraction of the $3.7 trillion in Japanese net external assets rotates into silver, the market cannot absorb it. The entire global silver market, all annual mine production, is worth roughly $25 billion at current prices. If Japanese institutions allocate just 1% of their repatriating capital to silver, that's $37 billion of buying pressure hitting a $25 billion annual market. The price doesn't adjust gradually. It gaps, it spikes, it goes vertical. Because there isn't enough physical metal to satisfy that level of demand at current prices. And here's why Japanese institutions would choose silver over other assets. First, it's not a Western financial instrument. Japanese investors just got burned holding Western bonds, US Treasuries, European debt. They watched those portfolios lose value as yields spiked and currencies moved against them. Silver is different. It's a physical commodity. It doesn't have counterparty risk. It's not issued by a government that can default or a central bank that can print. It exists outside the financial system. And in a world where trust in financial institutions is eroding, that matters. Second, silver benefits from the same forces driving the Japanese bond crisis: fiscal irresponsibility, debt monetization, inflation. If Japan's government keeps spending and the Bank of Japan eventually has to choose between allowing a bond market collapse or restarting quantitative easing, they'll choose QE. They'll print yen. They'll buy bonds. And that's inflationary. Silver is the perfect hedge. Third, silver is aligned with the global energy transition. Japan is heavily invested in green technology, solar, EVs, battery storage. If you believe the energy transition is real and accelerating, you need to own the inputs. And silver is the critical input. You cannot build solar panels without it. You cannot build EVs at scale without it. Owning silver is owning the physical bottleneck in the green economy. Fourth, silver is liquid enough for institutional scale but small enough to move violently. Gold is a $15 trillion market. It's huge. It takes massive capital flows to move the price significantly. Silver is a fraction of that size. It's more volatile. But for institutions looking to generate returns, not just preserve capital, that volatility is a feature, not a bug. If you can stomach the swings, silver offers exponentially more upside than gold. And right now, the risk-reward is asymmetric. Silver at $100 per ounce is still historically cheap relative to gold. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 48-1. Historically, that ratio has gone as low as 15-1 during precious metals bull markets. If silver closes that gap, if the ratio compresses back to historical norms, silver doesn't just outperform gold. It multiples. We're talking potential moves to $200, $300 per ounce. Not because of hype, because of reversion to historical valuation norms. Now, let me show you the mechanics of how Japanese capital flows into silver, because it's not as simple as a pension fund calling up a dealer and ordering 1 million ounces. Institutional capital moves through specific channels, and understanding those channels tells you where the pressure points are and where the price explosions will occur first. Channel 1, silver ETFs. Exchange-traded funds like SLV, the iShares Silver Trust, and PSLV, the Sprott Physical Silver Trust. These are the easiest way for institutions to gain silver exposure without dealing with physical storage, insurance, and logistics. When a pension fund buys shares of SLV, the ETF is required to purchase physical silver and deposit it in vaults to back those shares. This creates immediate demand for physical metal, and right now, ETF inflows are accelerating. If Japanese institutions begin allocating to silver ETFs, we're talking about billions of dollars of buying pressure that must be satisfied with physical bars. The problem? The bars don't exist in sufficient quantities. Refiners are already running at capacity. Lead times for delivery are extending. The ETFs will either have to pay massive premiums to source metal, driving up the spot price, or they'll fail to deliver, creating a crisis of confidence in paper silver. Either way, the price goes higher. Channel 2, futures and derivatives, COMEX, silver futures. Over-the-counter swaps. These are paper instruments, no physical metal changes, hands, just contracts. Institutions can gain price exposure through futures without ever touching a bar. But here's the danger. The COMEX has a long history of being a fractional reserve system. There are far more paper claims on silver than there is physical silver in the vaults. As long as most traders settle in cash and roll their contracts forward, the system works. But if a significant number of contract holders demand physical delivery, the exchange cannot fulfill those demands. It defaults. It changes the rules. It forces cash settlement, and that destroys confidence in the paper price. If Japanese institutions begin taking large futures positions and standing for delivery, demanding the physical metal, COMEX registered inventories will drain to zero in months. And when that happens, the paper price becomes irrelevant. The only price that matters is the physical price, and the physical price will be whatever the seller demands. We've seen this movie before. In 1980, the Hunt brothers accumulated massive silver positions and demanded delivery. The exchange changed the rules, liquidation-only trading, but the price still spiked to $50 an ounce before the manipulation crushed it. In 2026, the dynamic is different. It's not two billionaires. It's institutional capital from the world's largest creditor nation. You can't just change the rules and make them go away. Channel 3, physical bullion. Direct purchases of bars and coins. This is the safest, most secure way to own silver. No counterparty risk, no exchange default risk. You own the metal. But it's also the most expensive. Premiums over spot are currently elevated. Dealer inventories are tight. Mints are struggling to keep up with demand. If Japanese institutions decide they want physical metal in their vaults, they'll be competing with retail buyers, industrial users, and other institutions. And there isn't enough to go around. The result will be a bifurcation, a split between the paper price and the physical price. You'll see spot silver quoted at $100 on the exchange, but if you try to buy a monster box of American Silver Eagles from a dealer, they'll charge you $130 per ounce. That spread, that gap between paper and physical, is the signature of a broken market. And once it opens, it doesn't close until the paper market collapses entirely and reprices to match physical reality. Now, let's talk about the timeline. Because timing is everything. The Japanese bond crisis isn't theoretical. It's happening right now. The repatriation is underway. The capital flows have already begun. U.S. Treasury yields are already rising in response. But the silver move? That's just getting started. Here's how this unfolds. Phase 1, the recognition phase. This is where we are right now, January 2026. Japanese yields have spiked. Institutional investors are running the numbers. They're realizing that holding foreign bonds no longer makes sense. They're beginning to sell, but they haven't been fully reallocated yet. They're in cash, waiting, analyzing. This phase lasts weeks, maybe a month or two. During this phase, silver consolidates. It's already at record highs above $100. It might pull back slightly, profit-taking, weak hand selling. But the fundamentals are building. The pressure is accumulating. Smart money is accumulating. Phase 2, the allocation phase. This is when Japanese institutions make the decision. They've sold their foreign bonds. They've brought the capital home. Now they need to deploy it. They start buying Japanese government bonds. They start buying gold. And they start buying silver. This is when the ETF inflows accelerate. When futures open interest starts climbing. When physical premiums start widening noticeably. This phase probably begins in late February or early March 2026, after the Japanese election on February 8th, once the political uncertainty clears, once the institutions have certainty about the fiscal path forward. During this phase, silver breaks above $120, then $140. The move is sharp, volatile, but directional. The trend is clear. Phase 3, the acceleration phase. This is when the feedback loop kicks in. Rising silver prices attract momentum traders. Retail investors see silver hitting new highs and pile in. Media coverage increases. FOMO, fear of missing out, drives more buying. At the same time, industrial users panic. If you're a solar panel manufacturer and silver just went from $100 to $150 in 2 months, you're terrified. You start hoarding. Buying inventory ahead of need, this adds more demand, and the supply squeeze gets worse. COMEX inventories drain. Dealers run out of stock. Premiums explode. This phase could see silver hit $200 per ounce or higher. It might happen in Q2 or Q3 of 2026, and it won't be a smooth ride. Expect massive volatility, 20% drawdowns followed by 30% rallies, but the overall trajectory is up. Phase 4, the mania phase. This is the final blow-off. Silver is the hottest asset in the world. Everyone wants exposure. pension funds, hedge funds, sovereign wealth funds, retail investors, the price goes parabolic. We're talking potential moves to $300, $400 per ounce. Valuation doesn't matter anymore. It's pure momentum, pure speculation. This is when you sell, not to buy dollars, but to rotate into gold, to lock in gains, to reduce volatility exposure. This phase probably happens in late 2026 or early 2027, and it's followed by a brutal correction, because all manias end. The question is whether you recognize the mania while you're in it, or whether you ride it all the way back down. Now, let me address the elephant in the room, the US government. Do you think they're just going to sit back and watch the Japanese capital flee treasuries and flood into silver? Do you think they'll allow a foreign nation to destabilize their bond market without responding? Of course not. The question is, what can they do about it? Option 1, intervention in the silver market. The US government, through intermediaries like JP Morgan or the Exchange Stabilization Fund, could attempt to suppress the silver price. Flood the COMEX with paper contracts. Short the market. Drive the price down. They've done it before. The evidence is overwhelming. But here's the problem. In 2026, it won't work. Because the demand isn't coming from speculators you can scare off. It's coming from institutions with balance sheet mandates. Japanese pension funds don't care if silver drops 10%. They're buying for allocation purposes, not for trading. If the price drops, they just buy more. You can't shake them out. Option 2, capital controls. The US could attempt to restrict capital outflows, make it harder for foreign investors to sell treasuries, freeze accounts, weaponize the financial system. But that's the nuclear option. It destroys trust. It confirms that dollar-denominated assets are not safe. It accelerates the very thing you're trying to prevent. Capital flight. If the US imposes capital controls, every foreign investor, not just Japan, will dump US assets immediately. It's a self-defeating strategy. Option 3, yield curve control. The Federal Reserve could announce that they will cap Treasury yields at a certain level, print money to buy any bonds that exceed that yield, suppress borrowing costs through unlimited quantitative easing. This is what the Bank of Japan did for years. It's what they're being forced to abandon now. If the Fed goes down this path, it's an admission that the debt is unpayable, that deficits are out of control, that the only solution is money printing. And money printing is inflationary, which makes silver even more attractive. So the Fed's response to the crisis makes the crisis worse. Option 4, do nothing. Let the bond market reprice, let yields rise, let the economy slow, take the pain. This is the responsible choice. It's also political suicide. No administration is going to accept a recession voluntarily. So they'll choose some combination of options, 1 through 3. They'll intervene, they'll print, they'll try to suppress it. And every action they take will validate the thesis that fiat currencies are being debased, that government debt is unsustainable. Those hard assets are the only real store of value. Silver wins either way. Now, let's talk about who loses in this scenario, because every wealth transfer has winners and losers. And understanding who gets destroyed helps you avoid being in that group. Loser number 1, holders of long-duration bonds. If you own 30-year treasuries, if you own long-dated corporate bonds, if you're sitting in bond funds with high duration, you're getting annihilated. Bond prices fall as yields rise. If the 30-year treasury yield goes from 4.5% to 6%, the price of that bond drops by roughly 20%. That's a catastrophic loss. And it's permanent. You don't get it back unless yields fall, which they won't. Because the structural drivers, fiscal deficits, debt monetization, capital repatriation are all pushing yields higher. Bonds are a sell. And they've been a sell since yields bottomed. If you're still holding them, you're the exit liquidity. Loser number 2, holders of cash and cash equivalents, money market funds, savings accounts, yen cash, dollar cash, anything denominated in fiat currency. Inflation is coming. Not the benign 2% inflation central banks target. Real inflation, 5%, 7%, maybe higher. When central banks are forced to choose between defending their currencies and defending their bond markets, they choose the bond markets. They print, they monetize, they inflate. Cash loses purchasing power. If inflation runs at 6% annually and your savings account pays 1%, you're losing 5% per year in real terms. Over a decade, you lose half your wealth. Cash is trash. Loser number 3, equity investors in the wrong sectors. If you own banks heavily exposed to long-duration bonds, if you own heavily indebted corporations that need to refinance at higher rates, if you own companies dependent on cheap capital and low interest rates, you're exposed. Rising yields are a headwind for equity valuations. Price-to-earnings multiples compress, borrowing costs increase, profit margins shrink. The stocks that thrived in the zero-rate environment are the ones that get destroyed when rates normalize. Loser number 4, anyone who believes the system is stable. The people who think central banks have everything under control, who think government bonds are risk-free, who think the dollar's reserve status is permanent. They're about to learn a very expensive lesson. The lesson that systems built on debt, leverage, and money printing eventually break. And when they break, the break is sudden, not gradual. The Japanese bond market didn't slowly deteriorate over the years. It spiked in weeks. The capital repatriation isn't a slow trickle, it's a flood. And floods don't give you time to prepare. They just sweep you away. So what do? How do you position? Let me be very clear. This is not financial advice. I'm not a financial advisor. This is educational analysis based on observable market dynamics and historical patterns. But if I were looking at this situation, here's how I'd think about it. First, reduce exposure to long-duration fixed income. If you own bonds, shorten duration. Move into shorter maturity instruments or exit bonds entirely. The risk-reward is terrible. You're getting 4% yield while taking on massive interest rate risk and inflation risk. That's not a trade. That's a donation to the market. Second, minimize fiat currency exposure. Hold only what you need for operational purposes. 3 to 6 months of expenses. Everything beyond that should be in productive assets or hard assets. Fiat currency is a melting ice cube. It loses value every day through inflation. Every day you hold it, you're getting poorer in real terms. Third, allocate to physical precious metals, gold for stability, silver for upside. The allocation depends on your risk tolerance. Conservative investors might go 70% gold, 30% silver. Aggressive investors might flip that. 30% gold, 70% silver. But the key is physical, not paper, not ETFs unless you're absolutely confident in the structure. Not futures. Physical metal in your possession or in allocated storage you control. This eliminates counterparty risk. Fourth, consider mining stocks as a leveraged play. Silver miners are leveraged to the silver price. If silver goes from $100 to $200, the profit margins for miners don't just double, they triple or quadruple, because their costs are relatively fixed. When revenue doubles, almost all of that incremental revenue flows to the bottom line. But mining stocks are riskier. They're equities. They're subject to market volatility, political risk, operational risk. They're not a substitute for physical metal. They're a complement. A smaller allocation for those seeking higher risk-adjusted returns. Fifth, stay liquid and flexible. This is a volatile environment. Things are changing fast. You need the ability to adjust, to rebalance, to take profits when silver hits mania levels, to rotate into gold when the gold to silver ratio compresses. Flexibility is a competitive advantage. Don't lock yourself into illiquid positions you can't exit. Sixth, ignore short-term noise. Silver is volatile. It will have 10% down days. It will have corrections. Weak hands will panic and sell. The media will declare the rally over. This is normal. This is expected. The trend is your friend. As long as the structural forces are in place, fiscal insanity, central bank money printing, Japanese repatriation, industrial demand, the trend is up. Don't let short-term volatility shake you out of a long-term position. Let me show you the big picture one more time, because it's important you understand the full scope of what's happening. The Japanese bond market crisis isn't an isolated event. It's the unraveling of the post-1980s financial order. For 40 years, the global economy ran on a simple model. Western governments borrow, central banks suppress rates, emerging markets export, and Japan provides the capital to keep the whole system liquid. That model is breaking. Japan can't provide capital anymore. They need it at home. Their own bond market is in crisis. Their own government is fiscally reckless. Their own central bank is tightening, not easing. The flow has reversed. And when the flow reverses, everything built on that flow collapses. U.S. Treasury yields rise. European bond markets come under pressure. Emerging market debt becomes unsustainable. The dollar's reserve status erodes. And hard assets, the things that exist outside the financial system, re-rate to reflect their true scarcity. This isn't a one-year story. This is a decade-long transformation. We're in the early innings. The Japanese repatriation just started. The silver supply squeeze is just becoming visible. The institutional allocation wave hasn't even begun. But the direction is clear, the trajectory is set, and the opportunity is now. Because once this becomes a consensus, once every pension fund and sovereign wealth fund figures out that silver is the trade, the price will already be at $300. And the best entry points will be gone. Right now, in January 2026, silver at $100 is still cheap. Relative to gold, relative to the supply deficit, relative to the industrial demand, relative to what's coming. The window is open, but it's closing. The Japanese bond market just told you everything you need to know. The kill switch has been activated, trillions are in motion, and they're flowing toward the one asset that cannot be printed, cannot be defaulted on, cannot be controlled. The question isn't whether this happens. The question is whether you position before the crowd figures it out, or whether you wait until it's obvious and pay triple the price. The pattern is clear, the timeline is visible, the trade is silver, and the clock is ticking.